Mike, so we're following Jane Goodall, right?
That's a tough act to follow.
No more monkey business.
Talk about private equity saving the world, right?
Yeah, exactly. Okay, that wasn't so good. All right. Hello, everyone, and welcome to At Barrons. My name is Andy Serwer. I'm the editor-at-large at Barrons, and this is an interview with Michael Arougheti, who is the CEO of Ares Management. Mike, great to see you.
Oh, it's great to be here. Thank you. Thanks for the invite.
So for those of you who aren't familiar with Ares, Mike, why don't you give them an idea about what the firm is all about?
Sure. So the firm was founded in 1997. Today, the firm is close to $600 billion of assets under management in what broadly the markets define as alternatives, or said differently, private markets investing. We have market-leading businesses around the globe in private equity, real estate, infrastructure, private credit, and have really been enjoying a secular growth trend that's happening in private markets, as well as I think a couple of things that we've done well to capitalize on that trend. We have about 4,000 employees in 40 offices in 20 countries around the globe. And so I think that positions us uniquely to have a lens into the real economy on a global basis.
Yeah, I mean, you could make the argument that your firm is a little lower profile than KKR or Blackstone. On the other hand, for those of you who follow the markets, Ares stock has been the top performer in the sector.
Yep.
And you also have a higher valuation than these other guys. What do you attribute that to?
Management.
Yep. That's what you call
strong management.
The biggest softball question. Okay. How come your stock's up? Couldn't be you. I don't know how to phrase it that way.
It's funny because before I became the CEO of Ares Management, I was actually the CEO of our publicly traded business development company, Ares Capital Corporation, and ran that company for a decade before moving up to the parent. So in fact, we actually had a subsidiary company that was public and growing before we IPO'd the parent. I think what I learned, and it's reflected in the valuation, being in the public markets is fundamentally different than being in the private markets. So it's always, I don't want to say awkward, but interesting for us as private markets practitioners to also have this, large growing profile in the public markets. I think the key differentiators for us and what we've tried to do is simplify a complex industry so that people understand the role that we play in the global economy, what trends are driving the growth. And I think that's critical for success in the public markets, right? You touch so many different individual and institutional investors, and articulating just in very plain terms who you are, what you do, why you do it, and why they should be affiliated with you. And second, we've tried to be very clean in the financial profile of the business. And what I mean by that is we are a pure play asset manager. We manage capital for the largest sovereign wealth funds, pension funds, insurance companies on the planet, but we also manage money for hundreds of thousands of individual investors. And that's the core business. And I think a lot of our peers have changed the business model over time to be insurance heavy or balance sheet heavy. And I think it's gotten a little confusing. So we focus on keep it simple, execute on the core strategy, and then make sure that we're growing consistently, because I think, as a set of professional investors, the ability to underwrite a business plan and consistent performance is always key. And if you look at Ares as a firm, we've grown roughly 25% compound annually for the last 25 years in every market. Right. And I think, in the public markets, particularly in a world where attention span is shortening by the day, just that consistency and predictability, I think, has been a big underpinning of the value.
It's interesting you're saying you got this one foot in the private markets, the other one in the public markets. That's changing. We're going to get to that in a second, but I have to ask you about the public markets. What do you think? Whoa.
Well, that's it. That's what you scared me talking about the public markets.
Well, I'm going to scare you even more. What do you think about this crazy stock market with these crazy valuations right now?
Yeah, so I have the benefit of not having to invest in the public markets and having been in and around them for 30 plus years in my career now. I think it's getting harder to differentiate as an active investor in the public markets. You've seen cutting in half of the number of public companies in the last 25 years. You've seen a significant concentration in market cap in the top, in the top 10. You've seen the advent of passive investing, algorithmic trading, changing of the economics of research and intermediaries. So the structure of the market, I think, just makes it really, really difficult to generate alpha. And you can see that even over the last decade, traditional public equity managers are having a hard time growing their flows because people want to buy beta exposure. So I'm a big, big believer in owning equities and compounding wealth over a long period of time. But I think it's getting very, very difficult to be an individual stock picker. So what do I think? I think the public equity markets today are fully valued. I don't want to say that they're overvalued. I think that they are fully valued. I think they're reflecting this concentration of market cap. It's reflecting a change in the discount rate. And obviously there's a big wave of enthusiasm that's running through the markets right now around the technology sector, the AI revolution, and the productivity gains. And I could get behind that as a catalyst for value, but they're not cheap. Let's put it that way. At these value multiples, they're obviously well in excess of historical averages, and that's always cause for concern.
Right. So if you think what Ares invests in is maybe esoteric, too sophisticated for your palate, not something you're going to be interested in, you're wrong, because the world of private markets is coming to public investors. It's coming to your 401k. Increasingly, you're getting access to it. So I want to ask you about this democratization, if you will. The SEC just had an advisory group meet and talk about new guidelines. Ordinary investors are going to be investing in those investments that you have. How do you feel about that? And can it be done? Should it be done?
Yeah, I putting aside that we will benefit from the growth in that, I feel great about it because I don't understand why a large institution should have access to a differentiated investment and an individual shouldn't. And so without calling it democratization, but just increasing access and choice for individual investors with appropriate governance, I think is always a good thing. And I think innovation in the financial markets generally has been positive for the investment community. So I'm a big believer in that. I also remind people that most of you in this room or listening to this podcast have access to alternatives in other parts of their lives, whether it's your mortgage or your pension plan. So this idea of 401ks revolutionizing access, I think, is a little bit of a misconception because most large state plans, insurance companies, they're all investing in alternatives in a very large and diversified way. So it's not as though this is the first exposure people are going to get, but this will be the first time that individual investors will have the opportunity in their retirement plans to opt into these investments. And I think with the right structures, I think it's great for the investor.
But how do you respond to people who say, oh yeah, they're coming to retail markets because now the institutional markets are totally saturated. So where else are they going to go? And now they have to sell it to all the mom and pop kettles of the world out there.
Yeah, I've heard that many times articulated, and I don't know who's propagating that, but it's
probably the media.
Yeah.
You blame the media.
It's fake news.
Right. Yeah.
I think, look, anytime you go from institution to retail, people get anxious about risk taking. So investor protection, investor education has to be prominent in this conversation, but there is no reality that I see where lower quality assets find their way to the retail investor because the institutional investor is saturated. I have been, I don't want to say dampening the broader enthusiasm for this trend for that reason, which is to say the market is not short on demand for private markets assets. The market is short on the ability to create private market assets for people to invest in. And so it's great that we continue to open up these new distribution channels in insurance and wealth, 401k plans, but the constraint to growth and the proliferation of alts is the ability for folks like us to actually create new assets, build new apartment buildings, build data centers, buy companies, and all package, consumer loans and all of these things. So I think it will diversify the funding sources, but I don't think it's going to overwhelm the traditional institutional business.
Have you guys made any inroads? Because some of your cohort institutions have already put stuff out and done partnerships.
Yeah, we have
retail distribution.
We have, and I think that's a big part of the conversation now. Is it's fascinating. So when we went public, gosh, almost 15 years ago, the alternative asset managers in the public market were trading at a deep discount to the traditional asset managers.
Mm-hmm.
And part of the narrative that we were talking about was convergence. And what we meant by convergence was not that traditional assets become alternative and alternative become traditional, but that the consumer, whether it's retail or institutional, will want to buy liquid and illiquid exposures in one place. And that's now finally coming to fruition. But ironically, the valuation has flipped because the growth and the differentiation is now on the alternative side.
That's fascinating.
Yeah.
I mean, that hadn't crystallized in my mind, but that's absolutely true because they've had the outflows and had a tough time.
I think when we came public, they were probably trading an index basis at 18 times earnings, and the alts were maybe close to half that. And if you look at the alts index today, they're probably in the low 20s, and the traditionals are probably half that. So there's been a complete reversal, which is, it's only been 10 plus years. So that's a transformational shift.
One of the most exciting, albeit kind of small parts of the private space, but it gets a lot of attention, is sports. Mm-hmm. And you're involved in the world of sports. You're a part owner of the Baltimore Orioles, along with another private equity guy, David Rubenstein from Carlisle. So I'm curious about, but to the point of access to investors, there's a lot of talk about alternative managers like yourselves buying pieces and then, again, making them available to institutional and retail investors. So you could own a piece of the Dallas Cowboys. No, not that one. No, Jerry Jones, forget it. And I don't know if you'd want to here. We're in New York. But maybe the Giants, some of the Jets. No, you see what I'm saying?
I do.
Okay.
So, but that access is a fascinating example of how the private market opportunity continues to expand. So pre-COVID, the structure of sports investing, at least in the major US leagues and global leagues, was bank capital, largely supported by league guarantees and rich people. And there was zero innovation in the capital structure. There was no flexibility around how you would finance and grow these enterprises. And there was a strict prohibition on institutional capital investment. When COVID hit, and we were a big part of the solution here, you had a lot of team owners and leagues that were now struggling for liquidity because you had stadiums and arenas with no live events, and you were asset rich in the sense that you had these really valuable franchises, but no cash. And so that started to create a series of conversations with us and owners and leagues to say, how do we actually innovate capital structures here? It can't be that it's only banks and rich people. If we want to actually get through this and have sports investing accelerate again, we've got to be more creative. And we did a lot of missionary work and a lot of relationship building to allow institutional money to come into these markets. And you fast forward now 5 years since the pandemic, and each of the major sports leagues in the country, to varying extents with varying degrees of flexibility, are now open to international institutional investment. And if you take the NFL as an example, you mentioned the Giants. The Giants just sold a minority position to institutional capital. We made a minority investment in the Miami Dolphins and their surrounding assets. But we also, because of our access to the individual investor, are able to offer that exposure up. Now, you may say, other than the fact that it's really cool, if you're a sports fan, that you get to own a piece of the Dolphins or, Inter Miami or Atletico Madrid or McLaren Racing, which are all the things that we own. when you look at what sports assets do relative to other things you own, completely non-correlated outcomes relative to a traditional 60-40 portfolio, and have compounded at close to 15% rate of return for the last 15 years. So, but 5 years ago, uninvestable. 5 years later, you have a multi-trillion-dollar market that has now opened up to institutional and retail investment. And again, I think that's a really good thing for the investor with all of the appropriate, structures and protections.
It's a fascinating point about COVID being sort of something that triggered this to a degree. I hadn't realized that. The other thing is, of course, all this new capital, what has it done to valuations of these teams? Right? Because all of a sudden new money can come in, and we've seen what's been going on with some of these sales and the pieces.
Yeah, look, there's a scarcity value element to it. I mean, a lot of people used to say that sports teams were a store of value, and that thesis wasn't tested until now. And you really do see it, that the fact that there's just a limited number of these assets, and you have now a lot of liquidity wanting to invest in them, it should help fundamental values for sure.
I want to shift gears and ask about another, what I think is really fascinating part of our world that touches what you do, which is university endowments. And wow, my goodness, we've seen all the headlines about the headwinds facing universities. A lot of them have a lot of money invested in private equity. Now they need cash, and it's hard to get liquidity out of those. Your alma mater in particular, Mike's a Yaley, and Yale's famous for Dave Swenson, who sort of invented the Swenson model of going big into private equity. And then people are saying that, Yale's got a difficult time. You may beg to differ on that if you have any insight there. But what's the situation right now with university endowments and private equity?
Yeah, look, I think without getting into Yale specifically, but it is public that Yale, among other endowments, have actually been looking at the secondary markets to get liquidity, I think more to risk manage in the current environment than because they're under any, meaningful duress. But if you take the combination of reduction in NIH and research funding, an increase in the endowment tax, a reduction in international students, which tend to, pay higher tuition rates to support financial aid, a lot of large universities, public and private, are just, dealing with a new paradigm. And I think those that are forward thinking are liquidity planning because they don't know what the future holds. And again, I think what I find interesting about the university endowment model, the argument was always you can generate meaningful outperformance by investing in private markets, which David Swenson demonstrated, handily. But the risk was that there was illiquidity and that there would come a day where that would be detrimental. And I think by selling assets into the private market through secondaries at fair values, I think was a demonstration of the durability of these private market exposures that the endowments are taking. So I think the anxiety in that part of the market, at least as we're experiencing it as a counterparty to many of them, is probably lower than it was, 4 or 5 months ago when the world just felt a little bit less certain.
Yeah, and that secondaries market is just another huge growing part of the business to open up liquidity for not just the endowments, but for you guys. And then there are funds created from those secondaries that, again, retail investors are going to have access to.
Yeah, in many respects, it's creating liquidity in illiquid markets, which allows for continued growth in privates, right? Because again, the premise of investing in the private markets is you accept illiquidity and duration to get higher rates of return. I've always felt that the public markets, that we pay too much for liquidity, because at least my own experience has been, you don't want liquidity when it's plentiful. Like everything's going up, you just want to ride it up. And the minute that you want to get your money back, there's no liquidity and you don't want to sell at the value that liquidity is available. So in the public markets, I think it's always been a little bit of a mirage. And if it's there, it's not there at a price that you want. So if you can afford to take the illiquidity, and it's not for everybody, but if you can afford to take it, you will generate excess return compounding over long periods of time. And secondaries is just giving you, one more degree of flexibility to capture that return.
And final question, Mike. You said, I believe, that you want to double the size of the firm, or AUM. Correct me if I'm wrong, but how do you intend to do that?
Yeah, so the good news is, like I said, we have a track record over many decades now of growing at, meaningful double-digit rates of return. And so when you say we're going to double every 4 or 5 years, it sounds quite quite significant, but the math is the math, and we're actually growing at a rate of return that would have us doubling quicker than that. One of the, maybe bringing it full circle, one of the things I think that is underpinning our valuation and attractiveness as a public company is we put out guidance, typically put out 5-year guidance, which is quite unique for public companies who typically will put out a year of guidance with quarterly revisions.
Do you think President Trump's right about getting rid of quarterly?
I do, actually. I do. I think it's very, very difficult to stick to a long-term business plan and articulate success along that path if every 90 days you're having to communicate. So I think you can get to a similar outcome with a reduced disclosure regime, but the amount of dollars, energy, management attention, board attention that just goes into the quarterly reporting process is a lot. But anyway, the 5-year guidance, we're out with 5-year guidance that says we expect to be $750 billion plus of AUM, growing the company 16 to 20% per year, and we're well on our way to that. So yeah, I still have confidence in that.
All right. Ladies and gentlemen, please join me in welcoming and thanking again.
Thank you,
Michael
Andy. Appreciate it. Thanks for spending time with me. Thank you.
Thanks.
Thanks.